The Procter Gamble company stock is down 21% year to date. In this video, we will analyze the stock and try to come up with a fair value by calculating an internal rate of return based on the free cash flow of the company. Let's see if it is fairly valued right now. Currently, Procter Gamble is trading at a PE ratio of 22 and a forward PE of 20. The dividend yield is 2.77%. If we take a look at the last 8 years, we can see that revenue per share remained flat, but earnings and free cash flow per share grew, so they have been able to increase their margin. In fact, cash flow grew 3.5% annually over the past 10 years. Earnings grew 23% and revenue slightly went down 0.3% annually over the past 10 years. Now that we have an understanding of the company's growth rates, let's get into valuation. The number of shares outstanding has been steadily decreasing. That's something I like to see. We not only get a dividend yield of nearly 2.8%, we also get a buyback yield of a little bit less than 1% if we take the 5-year average. When we include analysts' estimates until 2024, we can see that Procter Gamble is expected to grow its revenue with 3.68% annually. This means that they will grow in line with inflation, maybe even a little bit below inflation for the next years. Which brings us to our normal case scenario for valuation. In this case, cash flow will grow in line with revenue because the company already improved their margin over the past years while revenue remained flat. I let them grow at 5% in 2025 and 2026 because we will probably still have a little bit higher inflation in those years, and I do believe that the company will be able to increase their prices with inflation. In the following years, I will bring the growth rate down to 4%. A fair free cash flow yield of 5% already seems a little bit optimistic to me, but it is a company that maybe deserves a bit of a premium because of their defensive business model. We can see the internal rate of return is 7% for our normal case, which isn't a market-beating return, but you get a nice dividend yield of 2.8%. In the best case scenario, I believe Procter & Gamble will be able to grow at 7%, and then I decrease the growth rate over time as our predictions get more and more uncertain. This already seems a bit optimistic to me, as there aren't any big changes made in the business model, and their revenue remained flat over the past 10 years. But even in this very optimistic case, we would just get an internal rate of return of 10.3%. The worst case scenario doesn't look too good, with an internal rate of return of only 4.6%. And keep in mind that I still kept them growing above revenue every year. This brings us to our combined result, which gives us a potential internal rate of return of 7.4% at the current price. This is no financial advice and you have to do your own research and make your own decisions. But I personally won't buy shares of Procter & Gamble at the current valuation. I personally don't like the risk and reward of the stock. In the best case, I probably would slightly outperform the market. And in the normal and worst case, I would probably underperform the market. Therefore, I would like to see the stock drop below $100 a share. At this point, I would probably step in and buy it. But if you are a dividend investor and want a defensive company, I totally understand if you invest in a company. What is your opinion of the stock? Do you already own it or do you plan to buy it? If you want to see a stock that I actually like, I recently made an analysis of Amazon, so feel free to watch that video and don't forget to subscribe if you want to see regular stock analysis videos.